Welcome to RBC's Markets in Motion podcast, recorded May 13th, 2024. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. 3 big things you need to know. First, reporting season has ended up looking just fine on the stats, but there has been a twist at the end. Second, we update our rundown of key themes on earnings calls. Third, net bulls on the AAII survey bounced back last week as 10-year yields decoupled from their 2023 spike. Hope for Fed cuts returned, and flows to U.S. equity funds improved. If you'd like to hear more, here's another 5 minutes. Now let's jump into the details. Starting with takeaway number 1. Reporting season is ending up just fine on the stats, but there has been a twist at the end. Reporting season is winding down for 1Q24, and the trends in most of the stats we've been highlighting over the past few weeks are still intact. In both large cap and small cap, beats have been more abundant on earnings than revenues, and companies that beat consensus on earnings have outperformed the broader market in terms of immediate stock price reaction, something we weren't seeing early on. The bottom-up consensus EPS forecast for 2024, meanwhile, is now tracking around $2.45, similar to levels in place last summer. The one thing that's changed in the stats we've been tracking in our latest update is that we're no longer seeing new earnings leadership emerging on all of the stats we're watching. The percent of earnings revisions to the upside has been a little bit weaker in the top 10 names in the S&P 500 than the rest of the index throughout most of reporting season. But in our last update, the top 10 names are actually starting to look a little bit better again on this stat. This shift in earnings sentiment argues the recent rotation in the U.S. equity market away from megacap growth and back to value and cyclicals may be due for a little bit of a rest. Moving on to takeaway number 2, what we've learned from earnings calls. As our regular listeners are well aware, our team reads through as many earnings transcripts as we can to get a feel for key themes. Core themes didn't change too much last week. Some of the things that jumped out to us from our reading include, first off, on outlooks, the macro backdrop and demand, we continue to see both positive and negatives highlighted. On the positive side, companies noted more capital raises in biotech, healthy travel demand, less concern about an economic slowdown, resilient consumers, easier second-half comps, continued tech investment, ramping AI, and reshoring. On the negative side, companies noted weak end markets, cautious consumer spending, inflation and labor pressures, post-COVID normalization, pushback on pricing, the anticipation of higher interest rates for longer, and cautious corporate decision-making. We exit reporting season with a sense that the strength in fundamentals has softened a little. One thing we didn't read too much about last week, or the past few weeks, frankly, also stands out. Complaints about uncertainty in Fed policy just haven't been coming up that much. This makes us think that recent messaging from the Fed indicating further hikes are unlikely may end up being a stabilizer for corporate confidence. Moving to inflation and costs, we again sensed a more balanced discussion than what we found last reporting season, when the hotter commentary on inflation in retrospect was signaling the greater than expected pressures from inflation that the government data releases would later confirm. This tone gives us some comfort heading into this week's inflation prints. Some companies highlighted elevated costs, but others noted lower input costs, progress on supply chains and labor, lower freight expense, more certainty about inflation's path, and the benefit from cost savings. Consumer commentary continued to be mixed and did have a bit more of a negative tilt than prior quarters. Weakness in the low end versus resiliency at the high end remained a key theme, as did characterizations of the consumer as choiceful, price-sensitive, and value-conscious. Positives that continued to be highlighted included resiliency and healthy travel demand. On geography, we saw the same thing last week that we've seen throughout this reporting season, which was that the tone around non-U.S. markets, especially China, seemed more balanced and a touch better than what we've heard in prior reporting seasons. Some specifically referred to China as okay, in a good place, or steady. Standout comments on the AI discussion last week actually came from utility companies, highlighting the boost to power demand from this trend. Interestingly, a number of investors referenced these comments from utilities in our meetings last week in discussions of why the sector has been outperforming recently. On this point, it's also worth noting that utilities flows have been improving. We'll wrap up with takeaway number 3, what else jumps out on our high-frequency indicators, and we'll do these quickly. 10-year yields are no longer following the path of their 2023 spike. This, plus the idea that the Fed won't hike again, and the return of cut hopes, have helped U.S. equities stabilize. Still, AAII net bulls moved up to 17% last week, and we continue to worry that the recent retreat in frothy investor sentiment simply didn't go far enough. And lastly, the outflows seen from U.S. equity funds recently may be ending. Blend growth and value flows within the U.S. are all improving. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.